All right. Good afternoon. Happy Monday, everybody. It is January 24th as we're recording this. We had some serious movement in the equities, and thank you all for joining me. It appears as though there's some sort of problem with the emailing from Zoom, letting everybody know that this meeting is beginning. I do apologize for that, but you will be able to see them recorded if you did not get the opportunity to catch them live.
Yeah, and congratulations to all of you troubleshooters here who I presume saw that you could just use the old links. So we'll be sure to announce that. I'm not sure, to my knowledge, we didn't change anything with the Zoom settings, so that was
No, not
unusual.
at all. No, just something weird happening, I guess. Gentlemen, it's good to see you. How was your weekend?
My weekend was very good. I don't know if I'll offend anyone out there by saying this, but both of the football teams that I follow have been terrible this year. And I got so much joy out of seeing Robbie Gould knock Aaron Rodgers out of the playoffs. Like that might have been my favorite game of the last 5 years, which says not much about the Bears, but oh, that was great.
Well, it's all right. A little friendly competition is not a bad thing, huh?
Yeah. Or unfriendly. I don't think we have too many people from Green Bay here, but I'll stand by it.
Well, I know one for sure, but I don't know if he's here right now, but we'll find out. Apparently there's somebody at my door. I apologize for that. I guess Avon is here. And all right, well, without further ado, why don't we go ahead and get started?
Absolutely. Yeah. And so if you guys have any questions, throw them into the Q&A section. JD and I will be diligently respond as much as we can. We're still working on that book list. We have it together, but we're figuring out the best way to share it. So we'll get that doc, as we mentioned, sometime this week, probably tomorrow. So take it away, Hogue.
All right, thank you. Sorry about a little background noise here. Of course, when we start something like this, all hell breaks on in the house. But so, what are we talking about today? We're talking about the auction process. Got to introduce myself as usual. Senior performance coach here at Topstep. More than February in a few days here, it'll be 39 years industry trading experience. We traded on the floor of the Mercantile Exchange as well as other exchanges for over 20 years. My dad was a trader on the floor of the Board of Trade for 40 years before that. My brother was in the industry. But in 2009, like a lot of folks, as the opportunities in the pit started to wane a little bit, the stepped out of the trading pit for the last time and started to learn how to trade on screen. And in 2011, joined up with Topstep. Loved the idea of offering a safe environment for traders to find out if their strategies are going to be good, to continue to develop and to grow as traders. And that's been my job here for the last 10, almost 11 years now, is to help traders from all over the world. I've had the opportunity to talk to thousands of them, help them improve their performance. And that's hopefully what we are doing here. Okay. So getting into the auction process, the idea is to think about what a market is anyway. The markets is an opportunity for participants to buy or sell a product at a time and place and a price that they're going to be able to make or take delivery of it in the future. The market's job really is to facilitate that ability to make it possible for producers, users, and as well as speculators to have the opportunity to participate in the auction process. The futures markets, forex markets, stock markets are really involved in a two-way auction process. When we think about an auction, we're usually thinking about starting a price at a lower level and seeing people compete to buy something until finally the last person pays the high price, and that's the end of the upside auction. Markets like this are two-sided auction processes. The price is going to, for example, move higher until it's viewed as too expensive. In search of sellers, buyers will back off, sellers will then take over. That begins a new auction to the downside, where price will continue to move lower in search of buyers, and the level where sellers are going to stop selling it because it's viewed as too cheap. Now, this process lives in just about every time frame. You know what I mean by that is, if you're watching the equities today, you know that we're in a longer time frame continuation or auction to the downside, almost a Dutch auction, and we'll talk about that here very shortly. But in shorter time frames, if we're looking, at a daily chart, yeah, we see that the market is in a trend to the downside. But in shorter time frame, we may, on a 5-minute chart, we may see little auctions in the opposite direction. So the fact that the market is offering these auction opportunities in multiple timeframes helps us be more liquid, if you will, for the larger timeframes. You've got lots of short time frame traders who are looking to take small bites out of small bits of the auction. You've got some traders that are looking for bigger bites out of some part of the auction. You've got bigger and bigger and bigger, more and more participants offering the opportunity to make it easier for traders, investors, producers, users to take part in the auction process without having to move price very much. So you may be looking at a trend on a daily time frame that looks like a good trend to the downside, but there's going to be counter auctions in smaller time frames in the opposite direction. Those might be just the pullbacks that are going to help us get into a bigger move to the downside, like we're seeing in equities today. And then, eventually there's going to be a point when the price gets too cheap for sellers to continue to sell it. You're going to find buyers down there. You're going to find bargain hunters. And the downside auction, believe it or not, even today or at some point, will end and a new auction to the upside will begin. Now, there's two different kinds of auctions, basically. There's the English auction, which whatever product is being offered is presented to those that are thinking about buying it. And usually they're going to be talking about how beautiful it is or what a great cow it is or whatever the auction is. Maybe it's a car. They're going to start the price and they're going to let the people in the auction compete for it. And by competing is usually there's going to be some sort of reserve where if nobody bids for it, they're not going to sell it. But if you get an auction that is robust, a whole room full of people can be competing for this car or whatever the product might be. And that's going to be a very robust auction. That's going to be an auction that's likely to continue until fewer and fewer participants continue to push price higher until finally that last person buys it. That's the English auction. Maybe that's a little bit of the reason why when markets are going up, they just kind of grind and stair step and grind and stair step up. It's always said that markets take the stairs up. The Dutch auction is done a little bit differently. They overprice the product and slowly lower price and lower price and lower price until somebody says, I'll take it for that, and the auction is over. Now, they also say that markets take the stairs up, but they also take the elevator down. We've been seeing for the last week in our equities a bit of the Dutch auction. The market just keeps pushing lower and lower and lower and in search of buyers that it is until maybe recently has been having a hard time finding. We've finally put in a bottom here and we're starting to see a potential upside auction beginning. Is this going to be a shorter time frame upside auction that's going to be contrary to the bigger auction that's going on in the longer time frame? Nobody knows. Nobody knows. So we've got a good idea that these markets are trading in auction processes. The thing that we're going to look at now is the factors or pieces of the auction process. Of course, price. Price is a big part of the auction process, but it's not everything. Price is really the advertising mechanism. When price moves up, it's advertising price at a higher level. If price continues to move higher, it's advertising price at a higher level. And if people aren't willing to pay that, okay, it's going to start to have to advertise price at a lower level, at a lower price. Excuse me. The short time frame scalper tends to focus really only on price and price action. You're going to be looking at opportunities to take bigger bites out of the marketplace. You may be missing part of the picture, and we're going to be talking about that part of the picture in week 4 when we talk about the market profile and value areas. Focusing on value can help, even if you're focusing on price, looking for context of the marketplace. Okay, volume. Volume gauges the power of the auction process. We're going to have a demonstration. Hopefully it might be kind of fun near the end of this presentation that we're going to talk about how important volume is to the auction process. But if the market is consistently moving higher or lower, and it is increasing in volume over time, when we think about the auction process, we want lots of people involved in that auction. That's going to keep price moving in that direction for a longer period of time and a greater difference in price. So whenever you see the market forecast or the market recap, we're always talking about how good volume was, especially when the market becomes directional in a longer time frame. You can be in a range bound market for a matter of days, weeks, or months, and you're probably not going to be seeing too much change in volume. But when that market state changes and there is a new auction in process, you're going to see probably a pretty big increase in volume during that period of time. So volume is a gauge of the power of the auction process. Increasing volume, more likely to continue. When we're thinking about acceptance of price or rejection of price, the factor that we judge that by, or at least I do and many others, is by time. If the market is spending a lot of time in a particular price range, it's gauging acceptance of price. Now, if you're watching the market forecast or the recap, when we talk about acceptance or rejection, most of the time, I'm talking about acceptance over time. If we break out of a balance area and we have a big trend day to the upside, the first thing my eyes go to is, well, how is the volume on that breakout? If there's an increase in volume, it's going to have me saying, okay, then this breakout is likely to continue, particularly if the market spends time outside of that previous range. Now, acceptance of price in time is very subjective, but so is everything in trading. We can be gauging volume as very good when the market might not be thinking that it is very good. We can also make the same errors in time. The beautiful thing is, when we see a market break out of, let's say, a period of range, and it spends time outside of that range and starts to build volume, at the very least, the breakout level of that gives us the opportunity to limit risk. Okay, there's lots of different ways to gauge time. There's, in the daytime frame, if there's a breakout on a daily chart, I want the market to close outside of that range. That's going to be telling me that the market is spending time outside of that range. Doesn't guarantee that the market is going to continue in that auction to the upside. It just gives you a higher probability. Again, acceptance over time. Time gauges acceptance of price. If you watch the market forecast, sometimes it will open with a late spike. Opening in the late spike indicates that through time, the market is accepting lower or higher pricing depending on the direction of the late spike. Okay, late spikes, all of these things we're going to be talking about again as we go through the market profile. I think that's day 2. Day 2 of next week, next Tuesday. The market profile shows a really good picture of where the market is spending time and marking acceptance, and areas where things may change. It's going to be a really good session and a longer one, probably next Tuesday again. And excess. Where did price go too far? Where did the auction get too high? Where did buyers get ahead of themselves and then end up basically paying the high and then having no buyers left and having sellers come in and quickly move price back to accepted value or a change in market state? Access is extremely important. If you are a disciple of candlestick patterns, excess can be seen sometimes in the shadows at the end of one of your candlesticks. There's hanging man, there's hammers. Those are all indications that the market is perhaps putting up a degree of excess at one extreme or the other, and we can use that excess to limit risk and looking for executions. Okay, excess is where price direction changes. So we've got price, the advertising mechanism. Volume gauges the power of the auction process. Time gauges the acceptance of price. And excess shows where little time was spent and where direction changes. So when you're looking at a market that is showing you there's a lot of time spent in the middle, very little time spent at the extremes, it gives you the idea, okay, well, if we're going to be looking for opportunities in this market, and rather wait for opportunities where we've seen previous excess to limit my risk, then trade where everybody's comfortable trading, right in the middle where the market has spent a lot of time. More on that in coming sessions. All right, more factors of the auction process. Open interest. Next Monday, a week from today, we're doing a whole session on volume and open interest and an introduction to Delta. We'll talk about Delta on that day, but open interest is quite simply the total number of contracts outstanding in any futures product or option product. Open interest is something we do discuss quite a bit on the market forecast, because when coupled with volume, open interest can help give you, again, a clearer look at how the auction process is doing. One of the things we say a lot is, okay, the market is attempting to go lower. How good of a job is it doing continuing in that direction? By gauging volume and changes in open interest, we can gain a sense of when an auction process may be getting a little bit tired, where maybe we're getting a little bit oversold, or in the other direction, perhaps overbought. again, the auction process happens in multiple time frames. When you're looking at a shorter time frame chart, like a 30-minute chart, you're probably going to see times where the volume is greater for the first hour, hour and a half of trade, and greater for the last hour, hour and a half of trade. But just remember that, these volumes are subjective, of course. What looks like good volume in the first hour of trade looks like bad volume in the middle of the day. But just because it's in the middle of the day and the volume looks lower doesn't mean that it's poor volume for that time of day. You got to remember the participants are doing more of their business at the on the bookends than in the middle, but it still might be telling you that there's decent volume in that time frame. And again, those auctions happen in multiple time frames. Be thinking about the various numbers of charts that traders look at, as well as the time frames that traders are trading in. You've got your scalpers, very short time frame traders. You've got your day traders. They're going to be looking at the auction in the time frame that they're looking at. You've got swing traders that are holding positions for days, maybe sometimes even a couple of weeks. They're going to be looking at the auction process in their time frame. And you've got your longer term traders, some of your bigger funds, anything, and your producers and users that are going to be looking really at the longer time frames for their auction information. Something else that can create an effect on the auction process is our fundamentals. Of course, supply and demand are certainly going to affect price, and they're certainly going to affect the auction process. Take a look at crude oil for the last few weeks. I mean, there's been some real question as to where supply is going to come from. We've seen prices going higher over the last year in crude oil. That's a function of the fundamental supply and demand, but it's also a part of the auction process, and paying attention to the fundamentals in day trading, sometimes not so good, but in keeping a good look at the context of the market over a longer period of time, fundamentals can certainly help just keeping the market in context, of course. And technicals. Traders look to the past to predict the future. There are patterns that they're looking for. There are levels that they are looking at. Markets are extremely visual. And as human beings, we are very in tune with catching patterns and then using those patterns in prediction of future price movement. It's just part of being a human being. And again, next week we're actually tomorrow, we're going to be looking at technical analysis, Wednesday, fundamental analysis. And then this week, of course, we're going to finish up with volume and open interest and a look into Delta. So as you look at the market, as you start to look at it as something that is part of a never-ending auction process, keep in mind these factors that are part of the auction process, and then use the tools that you're looking at to help you establish hypotheses as to, again, what is the market telling me? What are these factions of the auction process saying? And how good of a job is the market doing, trying to do what it's doing? Always important information. Some of the other factors of the auction process is motivation. You're going to have, in any given day, you're going to have traders that are motivated to get into trades because of mostly speculators I'm talking about. You're going to have traders, speculators getting into trades. Their motivation is really just about money. But as you get a broader view of the participants in the marketplace, you're going to have short time frame traders that may end up too long or too short. What is their motivation when they're getting out? Is it because they're they're cutting losses. Whoops. Sorry about that. Are they cutting losses? Motivation is, it's like everything. It's like opinions. Everybody has one. The motivations are going to be different across time frames. Your longer time frame traders are not as motivated by price. They're not as motivated by risk or by a risk aversion. You may open the market flat out lower like we did the S&Ps today. Well, what's the motivation of the sellers that are selling that market at a lower price than they could have on Friday? There's a couple of motivations I can think of. They don't want to lose any more of their money, or they're thinking, okay, this market is really going to start to head to the downside. I'd better get on before I get left behind. FOMO, maybe that's something that helped people in the last few days as this market continued to move lower. There's always the right time to do something. What about opinion? It's the difference of opinion that drives markets. Because we have so many different time frames, motivations, and opinions in this market, it's what makes them so thick and so usable for all time frames to use to hedge themselves or to look for opportunities for profit. It's the difference of opinion that really drives these markets. You've got lots of people of the opinion lately that the S&Ps and that our equities are overpriced, and we're going to need to adjust those prices lower. There's a whole bunch of traders out there with the opinion that let's let this happen, and when we think it's done, we're going to come in and we are going to buy some bargains. So opinion definitely has a factor in the auction process. Ego, fear, greed, the triumph. What is it? Well, it's the triumvirate of evil. Certainly has an effect on the auction process. As price continues to go higher and higher, who do you think is going to pay the high price? It's going to be somebody who's afraid they're going to miss the next move. You're going to have somebody that's already long that's saying this thing's going to go to the moon. I'm buying more, and it's greed that's going to cause them to pay the high price. And then, of course, there's always the ego. You've got a whole bunch of traders that are probably still holding on to longs that they are not going to get let go of, and they're losing a lot of money right now. Once they're out, once we get too short in the hole, all those buyers are going to come in, and we're going to move this market higher using the auction process. All right. So what I usually do at this point is we have an auction. We have an auction process, and we're going to auction off this piece of artwork. So I'm just going to pick a few people out that are going to they're going to be part of this. I'm just going to start at the top, and we're going to go as far as we can. We're going to go basically A's and B's here. Okay. So we're at an auction process, and all of us are sitting in this room, and they bring out this piece of artwork. This is a Leroy Neiman oil painting of the floor of the Chicago Mercantile Exchange. I remember when this was done, there's a whole bunch of prints out there. It's a nice piece. And as the auctioneer, I am going to be talking about what an important piece this was in the history, in the life and art of Leroy Neiman. Came to the floor and was moved to create this beautiful piece of artwork, and you can see the trading pits. You can see the flags that are hanging off the ceiling. You can see all the quote boards around. You can actually get close to this piece, and you can see the traders in the middle of the pit. You can almost feel the tension that's going on this trading floor. This is a signed print of it, so it's not going to be worth $500,000. What we're going to do is we're going to we're gonna open the auction process at $1,000 just for simplicity's sake. Okay. So as the auctioneer, it's my job to entice the members or the people in the room to really be interested in this piece and for to create some competition. Okay. We always, when we were talking about real estate, when you have people that are bidding against each other because they both want the house, that's an auction process. And it's a big benefit, of course, for the seller of the house, not so much for the buyers, but we're seeing some of that going on lately. Folks are offering their houses and people are competing for it, and people are getting more than they actually asked for the house. So we're going to start with this auction right now, and I'm going to hit the gavel on the podium and I say, okay, this market is open. Do I hear $1,000? Do I hear $1,000? And if nobody says anything, maybe they're thinking about it. Again, I'm going to have to pander, and I'm going to be talking about, this is a very important piece. It's signed by the artist. This is a wonderful piece to have in your collection. And if still nobody offers it, if I want to sell it, I'm going to have to auction the price lower, advertise the price lower. Well, how about, do I hear 950? No, do I hear 900? And Alessio says, yeah, I'll pay 900 for it. you guys are bidding here. All right, I'm just going to try and kind of run this so we have some organization, but I'm glad you got a lot of people that are interested here. Well, now Alessio's, we got it bought for $900 if nobody else makes a move. Everybody else in the room is starting to think, I do like this piece, and I think Alessio is getting it really cheap. So I think I'm going to try and bid for this. So Alexander says, I'll pay $950. Alexandre says, I'll pay $1,000. Alan says, I'll pay $1,100. Well, Alan goes up by $100. Now a lot more people are thinking, wow, these people really like this. And I kind of like it too. So I'm going to compete now too. Amith says, I'll pay $1,150. And M says, I'll pay $1,200. Andre says, I'll pay $1,250. Angela says, I'll pay $1,300. Anthony says, I'll pay $1,400. Anthony Robbins is here. And he just bid $1,400 for this piece. Now we've got all these people competing for this, and price is moving very quickly to the upside. Arians, I'll pay $1,500. Arnie says, I'll pay $1,450. Bandy says, I'll pay $1,500. Bartos says, I'll pay $1,600. Bilal says, I'll pay $1,650. And Bill Phillips says, I'll pay $1,700. Now, all those people that are bidding this piece up, some of them, like Alesso and Alexander and Alexandre, are kind of thinking this is getting a little bit too expensive. So they've stopped bidding. We've got Alan, who's bid now $1,800. We've got Amith, who's bid $1,850. Now people are starting to think, $1,850, that seems like an awful lot. It seems like an awful lot. So what am I gonna do? So now that the bidding slows to the point where there's nobody, I think it was Amith bid $1,850. I think that's right. So now we've got Amith who says, all right, I guess I'm going to buy this for $1,850, and the bidding stops. Not only did the bidding slow on the way up to this level, now the bidding has stopped. Okay, so I'm not just going to say, okay, sold at $1,850. I'm going to pander a little while. I'm going to say, you know what? This is a great price for this piece. It's worth, so much more. And, whoever brings this piece home is going to be lucky to have this for the rest of their life, and blah, 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 blah. That's the market pandering. You have the market moving higher over time. As the auction process starts to fall off, it consolidated. That's what we're doing here. We're consolidating in $1,850, and Amith is still on the hook for this. So I pander a little bit more. And if nobody else bids for this piece, Amith is going to get it, and they're going to take it home for $1,850. But we have Kevin, who is now standing in the back, wasn't part of the auction process, and he bids, I'll pay $2,000. So now I'm going to be going crazy as the auctioneer. I'm going to be saying, we have a new participant in the marketplace. We have a new participant in the auction. He just You just rammed the bid up to $2,000. Now, all the people that were in this auction process before might be sitting back thinking, well, what the heck does he know that we don't know? Now, sometimes buying begets more buying. So we've restarted this auction process to the upside. And now we've got Bill Phillips, who says, I'll pay 2,100. And Bartos says, well, I'll pay 2,200. And Arnie Bender says, I'll pay 2,250. And Arian says, I'll pay 2,300. And Kevin says, I'll pay 2,400. Now we've got the auction robust to the upside again. We've got people competing with each other until finally we get up to about 2,600. And Kevin says, I'll pay 2,600. Now, maybe he's put that as his last bid, but now he's got it to the point where nobody else is willing to outbid him. So I'm going to pander again. We got up to 1,850. We pandered. Now we're up at 2,800. I think we said 2,800. Wow, we did good with this auction. Now we're up at 2,800. Kevin is the last bid. Nobody else bids it. I'm not going to just say sold to Kevin for 2,800. I'm going to go back and say, okay, this has been a really good auction. Some really good action here. This is your last opportunity to own this particular piece for this value of 2,800. If nobody says anything, I'm going to say going once, going twice, sold. Kevin is going to stand up and he's going to hug his friends or whoever he's with there, and he's going to be proud and excited that he bought this piece. And then he's going to turn around and he's going to say, hey, all you folks, I just bought this piece for $2,800 and I'll sell it to you right now for $3,000. You think anybody's going to buy it? Nope. So we had an English auction on the way up. We had buyers competing for each other to get the best price. Once the price was found, it's going to be the high tick. If Kevin wants to sell this, he's actually going to have to action price lower until he finds a buyer. We go from the English auction, to the upside to the Dutch auction, where he's just going to have to offer price lower and lower if he really wants to sell it, take a loss on it until somebody says, okay, I'll take it for that. And that's the end of the auction. So I hope that this was a good kind of explanation of how the auction process works. The more people competing for it, the better off price has the chance to continue in that direction. And another reason why the downside seems to be so much faster than the upside. All right. More info. We've got the forecast recap playbook. We got Q&A with the founder. We got funded trader interviews. We got market therapy. And I still have to get a thumbnail for the blog, which is now running again, which is wonderful to see.
Yeah. The blog or the podcast or both?
Or the podcast. Yeah, both. Sorry. I meant the podcast. Sorry.
No worries. Cool.
Right.
Well, that was interesting with the auction about when you've expended all the buyers, you either need new blood to come in or it starts dropping pretty quick.
Yep.
Yeah. Well, I saved one question for the end that was on there earlier. JD, first I see someone over there. Could you put the market forecast into a playlist that way we can loop them? I guess that's something we talked to Holden about, JD. I'm just reading the comments.
Yeah, somebody mentioned that last week.
Okay.
Also.
Noted. I'll see if we can do that.
That's not a very heavy lift. I think we could figure something out for that for sure.
Yeah. All right. Here's a question from earlier. This is a good one. Would it be fair to say, it's a little bit long, so bear with me. I'm going to try and read this. Would it be fair to say that a specific support and resistance line is in fact a zone? And if so, what percent to either side of this specific price would John or one of the other coaches consider an acceptable zone size for an entry and stop loss? I understand that this may vary within various products, but just as a general rule of thumb, maybe we could get a percentage value on both sides.
Okay.
Well, I can start. Yeah. Oh, you take it away to start.
Well, okay. Well, this is a really good question. And something I try and remember to tell folks, when we're looking at weekly kickoff levels, which yes, of course, didn't stand a chance today. but that's why it was so close to the bottom of the S&Ps and the NASDAQ, was because we were looking for, some pretty quick continuation to the downside. But anyways, any level, any fib level, any support resistance level, any trend line is part of a zone. There's really nothing that is that finite when it comes to futures trading. It's whether you find acceptance either on either side of that zone that's so important. Now, as for a reasonable percentage of risk on either side of that, I think, well, in futures, if we're looking at percentages, we're not looking at very big percentages. When I see a level like that, technically, let's say there's a support and resistance line. All right, well, price gets down to it. What's the size of the market at that time? How close to into or through the zone do we get before we execute? And where is the point of invalidation or the stop level? Stop levels should be placed not financially, not through some sort of static chosen level. They should be technical. And the bigger the market, we've got a lot of volatility in the S&Ps. That's going to probably expand the risk I'm going to have to take on any trade that I take. So it's a level anonymous, where you have to have a good idea of your risk appetite. If you have a small risk appetite, you're going to want to be trading in that zone or through the center of that zone, maybe past, because that's going to help you limit your risk. If you have a little bit greater risk appetite, getting at the beginning of the zone or right on the number, might be a good idea. But again, it's very, very important to recognize the kind of market states you're in. Anything in the S&Ps today, if you're not risking, 5 to 10 points, I think, on any entry, you may cut yourself by 1,000 cuts. And for a lot of folks, that may be too much risk. So, I've been telling people since, the beginning of, last week, if this isn't your market, you don't have to trade. If the risk is too great, you're better off holding off and waiting for markets to align better with your strategy.
Yeah, we talked actually on the podcast on Thursday, Limit Up. We talked all about stops essentially. And as far as your stops and profit targets and the size you trade are integrally linked to the volatility of the market. In general, if the market's more volatile, less size, wider stops, wider profit targets, and the inverse is true also. So there's a lot of different ways. So percent is hard because it's going to change based on it. But if you look up things like, volatility stops or things like that, it'll give you an idea. For example, we talked about, just as an example, use something like the ATR moving average, like an average true range. That will give you an idea of what the price has been doing recently. And you can adjust kind of what your range is based on that. But yeah, there's no one size fits all when it comes to what your targets are. It's got to be based on volatility. And mainly, I'd say more, Dan mentioned when we were talking, the biggest mistake we see people do is have their stops and profit targets too tight compared to their size. People always want to trade more size than they should be. Some psychology there we'll get into at some point, but that's what I would say there.
Thanks, Jack.
So I don't see any other questions in the Q&A for now. So if anyone has anything else, we can shoot. Oh, here we go. I've heard veteran, and by the way, I've taken a risk here because I'm just reading it without having read it before. So hopefully this person isn't trolling me. I've heard other veteran traders say that they only focus on certain commodities such as ES, NQ, and YM and study them like as if they're their children and no other characteristics. Yeah, not quite. Like the comment makes sense there. I guess we can expand on it a little bit. Is you shouldn't trade probably more than a few products, and you should know their characteristics very well. You can find it on the CME, but a perfect example is, I'm sure you all remember God, it was more than a year ago. Time's flying. When those oil futures went negative, well, there was a lot of people out there, including brokerages, who did not realize there was nothing at all that said that oil futures had to stop at zero. They could, in fact, go quite negative. So you saw, ultimately, I think the brokerages ate most of them, but you had people buying tons of futures for 1 cent, thinking like, oh man, 100 oil contracts for $1, I don't care about losing that. And then suddenly they went down to, what they go down to, like negative
Negative
50
40 almost.
Yeah.
Negative $40.
Yeah. So I think Interactive Brokers took like an $80 million loss from clients trading negative oil because they just didn't know the product, or just something like that could happen. So you definitely got to know that. Yeah.
Yeah, that was the tulips of 2 years ago.
Yeah. How important is seasonality in trading? I think that my initial read on that question was seasonality can be very important as far as kind of when to trade, like very seasonal, like around the holidays and things like that tends to be kind of low volume, not great times to trade outrights. There's conflicting evidence on whether certain months, like there used to be this thing that October was when all this mayhem happened, but the stats don't really bear it out. The big moves, like you think of COVID or something, you can't predict when the big stuff's going to happen. Hug, what do you think about seasonality in trading?
Well, I mean, it's the reason futures traders were created. It was it gave producers and users of grain back in the mid 1800s the ability to protect themselves from seasonal price risks. Everybody in the Midwest is harvesting at the same time. There's a big glut. Nobody wants to buy it then because there's so much of it. And then 6 months later, after it's all been thrown in the river, and there's a bread company that needs wheat and they can't find any, price tends to go higher. So when we're talking about agricultural commodities, I think there's definitely a seasonal tint to them. But as far as trading overall, beginning of the year, you got all the funds, everybody's got to make their money for the year. They tend to try and get started early. End of the year, holidays, sometimes a little bit slower, although I've seen some pretty good holiday markets, but it's very difficult to try and predict anything.
There are funky times, and they apply more, especially if you're trading stocks or options. Obviously, they revolve a lot around earnings reports and things like that. But also, as far as things like quarterly option expirations can lead to some interesting volatility and moves, but probably not as much in futures, but it's just something to be aware of. Let me see. Out of interest, is it possible for all futures contracts to trade into negative zone, or just the CL? Now, because I don't know all the futures contracts, my instinct would be that any physical commodity like oil could go negative. Something like the S&P 500, we'll all be, eating each other before it goes to zero, but I don't believe that. I don't believe those can go negative. I'm trying to think about it. I don't think they can go negative because at zero, all the equity would be wiped out and there'd be nothing left to trade.
Yeah, all the stocks would be zero. Everything would be. Yeah.
Same with, and that presumably applies to all the financial instruments as well. What about Fibonacci? How's that come into play? I guess I mean, I don't trade using fibs. I don't know if this is asking like, what are they? I think
it's the zone question. Are fibs a zone, or are they? Everything is a zone.
Yeah. Yeah, it would be the same thing. Everything's got a little bit of give and take. Where's the best place to get news for data or agriculture products? I wish Mick was here to answer, but you guys have any ideas?
Well, there's news about everything in Twitter, but is it reliable is kind of the question. There's not too many news like wires that focus on information about grains or meats? It's a good question. Something we're going to have to look into.
Yeah, if you're looking unpaid, there is some good. You got to sift through it, but there's some good stuff available on Twitter. Like when we were trading, we'd always have Twitter open. But yeah, the really good data you always have to pay for, especially when it gets to those sorts of things. Yeah, so sorry. So ESNQ can't go to zero, but natural gas could. Yeah, just to explain in a minute, the reason why is when an oil contract or a natural gas contract expires. So like we'll use a oil, sorry, just wave into the baby real quick. We'll use an oil contract as an example. So if you had to deliver an oil contract and you were like short 1,000, that means you have to deliver, if it's a US like the CL, and tell me if I'm wrong, you'd have to deliver 1,000 barrels of oil to Cushing, Oklahoma at a specified date. Now, obviously, I cannot do that. And if I was forced to do that, it would cost me a lot of money to do, right? It would be a huge pain in the butt. And I'd be forced to pay someone to do it for me, right? So that's how those things can go negative, because it costs money to deliver physical options or physical contracts.
And what happened was all this crude oil was to be delivered, but there was no place to deliver it to. Everything was full. So now you're stuck trying to sell these contracts after expiration or before expiration, and nobody wants it.
Yes. How important is it to understand macro and economics in trading? Okay, I'm going to answer this and try not to. Yes and no. I think you can be a very good I think sometimes people who want to trade get too bogged down, and this pains me because I'm an economics guy, but like a lot of that isn't going to affect your day-to-day day trading thing. Like you shouldn't really be putting on trades on a day-to-day basis. I feel from your interpretation of economics, at least for a day trading time frame, that'd be kind of wild. But I think that in order to understand your product, for instance, like we were talking about before, you need to have a decent understanding or what could happen. Like we talked about the Twitter thing. If there's a headline risk or something like that, you got to know when to get out, or if something's bad or what something could mean. So I think it's important to know these things, but you don't need to be a economist to trade futures. Are you using Elliott waves to any extent? I do not. Do either of you? Yeah. Those are a little, I mean, I don't know if I'll get hate for this. They seem a little woo-woo for me, but whatever works. Like the slight against all technical analysis is that it's kind of like using a dowsing rod to find water, right? But all the market's psychological. So the way I justify it is that you take like the 200-day moving average. Every trader out there's looking at it. They're all waiting for it to get there. And if everyone decides something's an important level, then it is. So it's not magic. But you might have to ask someone else about the Elliott wave.
And nothing works all the time. Nothing never works. And it's managing the risk in and around them that's most important.
Simple moving average versus exponential moving average. What do you use, Hogue?
No, it depends on my daily simple, on shorter time frames, exponential or Hull.
All that exponential smoothing.
Yep.
Which kind of YouTube playlist should I start with if I have very little idea of trading? I'm trying to think of what a good resource for that would be.
I think he's referring to Holden just set up that forecast playlist that was requested in the chat. So I think he might be asking what's the best Topstep playlist to get started with.
Because we're not like a formal education company. I'm trying to think if there might be like the best. I'm trying to think of something out there that has a built out sort of absolute beginners program to get your feet wet. I guess watch the earlier Trading Foundation videos would be a good one at the link.
That's a good start.
But also, you know, the CME, someone says the Rational Investor. There's some bite-sized trading clips on the YouTube channel. The CME website, I believe, has resources and like some classes about futures. They're reputable, obviously. Out of left field. Out of left field, where are you guys all dealing with the Russia-US situation in Ukraine? Feel free to blow us off if it's not the time or place, but I'd love to hear what your thoughts are. I mean,
I'm dealing with
Putin,
it by praying.
yeah, Putin and Biden are not listening to us, so we're not super involved in it. Obviously, I hope it all turns out great, but it's definitely something. If you're just talking, like, I'll be less of a smart ass about it and be like, it's like we talked about the economics thing. It's something you got to pay attention to, and kind of be aware when you have your stops or your plan for getting out or putting on trades. That, you know, if something really moves, don't just fade it right away, or you'll go with it. Like, ask, whoa, something just happened. Why? And when there's a geopolitical thing in the charts, that's different than the moves that you see day to day. Even this big sell off today is not like that. You'll see something go. I mean, back when I was trading, there was a somebody hacked the AP news. This was like in 2013, 2012 or something like that. Someone hacked the AP Twitter account and just sent out a message that said that like a bomb just went off in the White House, and just like the market just evaporated.
I remember that.
Yeah. Stuff like that is, you got to know when it's just like hands off for a second. Let's see what's going on here. Do you offer a similar type of training focused on Forex instead of futures, or any type of information around the Forex Combine? We're going to be amping up a lot of our Forex stuff this year. We're holding off until we make some big changes to the program. We're going to make it a lot better, we think. I would say that most of the things we're talking about here, Forex trading is a little bit different, but for instance, there's, you know, currency futures. Is the actual fundamentals of trading are not that much different. Hogue, is there anything you would add about that? Because you talk about Forex, or at least Forex futures.
It's you know, technicals, technical analysis. It all, you know, it all comes with the same pattern. So very similar opportunity.
Yeah, the actual trading isn't that much different. I have never traded Forex myself, so yeah, I'll leave that to people with more experience on that. Okay, well, we're through the questions here. So yeah, hinting at that Forex thing. So watch out in the next few months. Hogue, take us away.
All right. Thank you, everybody. Tomorrow, technical analysis. Technical analysis is a huge subject. We're going to touch on pieces of it and maybe come up with some opportunities for you to continue your education in technical analysis, of course. You know, head to group coaching. If you're heading to group coaching, I'll see you in about 5 minutes. And again, looking forward to seeing you tomorrow. I do apologize if you did not get your email from Zoom. That's something that I got to double check the setting on, but good job using the same link to get in. And I look forward to seeing you again tomorrow. Have a great day. We'll see you tomorrow.